closing bell. We're here with Bob Genader. We're at the Ambac Post. He happens coincidentally to be the chief executive of Ambac. Welcome to the program, sir. Just for benefit of education to some of the folks at home, this company is the second largest insurer of bonds in the world. Among those bonds that are insured are bonds that were issued by all sorts of financial institutions. It's collateralized by mortgages for people's houses. They call them CDOs now. Basically, you were insuring bonds where the payment stream was a function of whether people paid back their mortgages. Fair enough? You also have been running this company for 5 years, and you've been in the business for 25 years. So you know what you're talking about. No secret to you that your stock is the single biggest decliner in the S&P 500 today, that your stock has lost half its value in the past month, that Citigroup, trading all around the corner here, is at a 4-year low and suffering one of its worst days. All of this ties to anxiety about whether the mortgage borrowers will be able to pay back those cash flow streams into the bonds that you have insured. That's the whole Megillah, right? What can you tell us about your understanding of how big the risk really is in those bonds right now?
Well, the bonds that we insure at Ambac are all AAA in the CDO sector. And what started out as a mortgage consumer crisis has eventually led into a fairly significant liquidity crisis. One of the strengths of our industry and our company is we don't take liquidity risk. We don't have to warehouse lines of credit. We don't have to keep lines available to originate business. Our bonds are basically a buy and hold type of security. Very different than what you're seeing the investment banks do.
Understood, but as the insurer of some of those bonds, where not necessarily the bonds that are issued by Ambac to support Ambac's business, but the bonds that you insure in the open marketplace, which are CDOs issued by other financial institutions, which have been regaled for their AA and AAA ratings, but at the same time criticized for their default. Considering the quality of that rating, what can you tell us about whether, in fact, those securities are misrated and, as a result, you have a greater risk than everybody thought you might?
Well, first of all, we use our own ratings, and so we rate the transactions. All of them are AAA, and how we actually dig into them is we drill down. In a case of some of our transactions, we will look at 15,000 individual CUSIPs. We will then project current rates of loss and future rates. We are very comfortable with that portfolio and our detailed analysis that we update every single month.
At the same time today, bonds of your company, as you know by this firm, Gimme Credit, were downgraded to deteriorating. They were rated stable prior to today. That's part of the reason why we look up into your stock down $6 right now.
Well, there clearly is a disconnect between the value of our portfolio, which is in very good shape, versus what has happened in the stock price in the last couple of months. Over time, because we are very much of a long-term risk taker, we don't have to trade the portfolio. Our company is very solid and very safe.
I want everybody to take a look at a chart that we prepared. It shows your stock price,
yes,
and then it shows your earnings stream up to this point. And I have to thank Carter Worth yesterday, who's the chief market technician. And you can turn around with me. We'll look at it together because there's a return here. So you see up here, the blue line is your stock price. We all know it's gone down a lot. I'm sure I don't have to educate you on that. I'm sorry to show it to you. Your earnings stream, however, has held up quite nicely on that chart. One of two things in theory is going to happen here. Either your earnings are about to fall off a cliff, sir, or that stock price is too low. Which one do you believe is the case?
Well, stock price is definitely too low. The earnings stream in our business is you earn your premium over the life of the bond. If you're taking a 30-year municipal bond, you recognize 1/30th of that over the life of the stream. So that earnings stream is very stable. It's like an annuity. It's very predictable. In fact, analysts can tell you right now, almost to a penny, what our fourth quarter earned premium will look like.
How, though, do you integrate the risk of default on the payee, the borrower who can no longer pay their mortgage, which is part of the cash flow stream that is coming to pay the coupon on your bond?
Good selection at the initial underwriting, good modeling, ensure that you're dealing with the best possible issuers. And then what we do is we update, we give you a new rating every single quarter on the quality of our insured portfolio.
But are you saying that the Gimme Credit downgrade of your bonds and the equity trader's decision to sell your stock down, it's the biggest decliner in the S&P, lost half its value in a month, is a function of a misunderstanding of your business, that they don't understand what you do?
The quality of a portfolio and the confidence, although we disclose a tremendous amount, most analysts get it. There is a sector out there that may not fully understand exactly how our earnings streams work. what the importance of a unrealized mark-to-market.
Why, the biggest reason, look at that, I mean, the reason the market is because the financials inside the Dow right now are extending their losses on concerns about the bonds. And I'm not making this your problem. Obviously it is not. But as an expert here, and we look at this picture, why do you think that's happening if you're telling me that the bonds are fine?
Because our portfolio is very different than when you're looking at a other investment bank. Our portfolio is regular scheduled principal and interest. So if that CDO has a problem, we'll make a payment, but it will be stretched out over the life of the transaction. We are a very stable earning company because our risks are spread out and they're diversified.
What's your quantification then of the risks that are driving this sort of behavior right now?
Well,
as an expert, forget Ambac for a second, just by virtue of your 25 years trading bonds and being around fixed income securities and the risk that's expressing itself right now in the stock market.
Well, clearly the markets must be concerned about the overall quality of the mortgage performance. Our performance as Ambac is very different than the rest of the market.
Understood. Bob, it's a pleasure to make the acquaintance.
Thank you.
We all appreciate, and not just myself, but everybody appreciates you taking the time not only to come here on the floor, but to have the conversation, to look at those charts with us. We will take a momentary break. You see the deal. Stock market selling, down 300. Don Marin, one of the brightest on Wall Street, with Maria here on the closing.